Hi, and welcome to the mortgage update for July 2021. My name is Richard Purnell. For those that don't know me, quick brief introduction. I've been a mortgage broker for over 20 years, and we do specialise particularly in helping landlords, whether they already have a significant portfolio and want to review the effectiveness of that, whether they can release additional equity, whether they can increase their profits by reducing interest rates, or indeed, maybe you're just about to get your first property, just getting on the lander. We're happy to support new landlords as well. I'm also a portfolio landlord myself, also for over 20 years, so can wear two hats sometimes to support these landlords on their journey. So first of all, as usual, quick look at Market Watch. So the Bank of England base rate has stayed at 0.1% yet again. It's been well over a year now that it's stayed at this low historic level, and there's no suggestion that it's going to move anytime soon. So not a lot to be said about that, other than the committee, the Bank of England committee, unanimously recommended it stay at that level before. So I think there'll be little change there, and therefore will have little impact on mortgage rates. Now, green mortgages, I've seen a lot of these coming on the market, both from high street and non-high street lenders. What are they? Well, essentially, they're just like any other mortgage, but to be eligible for these, you have to hit certain criteria. And depending on the bank or lender you're talking to, that criteria may change. So I'll just give you a couple of, for examples. So one is, if to be eligible for a certain mortgage with some lenders, you have to have an EPC rating of A or B. So that's Energy Performance Certificate. The energy efficiency of your home or your investment property would need to be of an A or B rating, and that makes you eligible for these particular rates, which are slightly preferential to anybody else. So that could be quite interesting. Another example would be if you're wanting to apply for a further advance. So you're already with a particular lender, and if you want that additional borrowing to improve the efficiency of your property, so you may want to invest in new heating systems or insulation as examples, then again you may well be eligible for preferential rates for additional borrowing. So look out for that. TMW, that is the Mortgage Works, if you didn't know, owned by Nationwide. So they, if not the first, probably in the top 2 or 3 largest buy-to-let lenders in the UK. And in the last few weeks, they have slashed mortgage rates. Had a look just before we came on, I think 1.39%, the lowest rate I can see there, for a 2-year 75% deal. So whether you're eligible, obviously we don't know. You need to speak to an advisor and get advice on that. But as a headline rate, staggeringly low. So they're clearly trying to get rid of maybe a tranche of funds and increase their volume. Metro, here's something that stood out for me. Now, usually when you are looking to organise a buy-to-let mortgage, the lender will insist that the tenancy you're going to put in place, or indeed already have in place, can be no more than 6 to 12 months long. Yes, of course, you can renew it as you will from time to time, but that is the standard policy rule pretty much with every lender, that the tenant can only sign up for an AST between 6 and 12 months. Metro have said you can have an AST for up to 3 years. And it's the first time I've seen that in place. So if that applies to you, if you've got tenants that have those longer tenancies in place and you are struggling to get mortgages, then Metro may well be the lender for you. Finally, on Market Watch, holiday let mortgages. You might think, yeah, it's common sense that lenders would be getting into this market for all the obvious reasons, where staycations are certainly going to be here for some time to come, and the uncertainty with travelling abroad. Therefore, lenders are starting to put feelers out and put new products out for holiday lets. And so more competition, of course, will clearly drive rates down. Now that brings me on to my spotlight for this month, which is let's sort of dig a little bit deeper into the holiday let situation. So we know there's going to be growth in demand for holiday lets, and landlords tend to be at the cusp of that. They're not slow in responding to an increase in demand and a lack of those sort of properties. So lots of our clients are looking at their existing portfolio to say, is it appropriate to move from long-term let to short-term let? Are my properties in that sort of touristy area that would attract holiday let guests? And lenders, though, are a little bit slower. They're clearly going to be more cautious. We're literally only getting announcements from the government in the last few days about what the next stage 4 is going to look like. And so you're not going to find lenders pushing new products out en masse. They are starting to do that in some cases, but I suspect it's going to be the next few months, maybe up to the next 6 months before a significant number of holiday mortgages will come out there. Now, what we are seeing right now, when I move to that second bullet point, is how do these holiday lenders work out how much they're going to lend you? Now, because the gross income from a holiday let is significantly more than a normal long-term AST, for example, then we are seeing a significant number of those lenders saying, yes, we'll lend you a mortgage and we'll put it in the terms and conditions that we allow you to use it for holiday let purposes. However, and here's the rub, the way they calculate the borrowing is on the long-term AST rental figure, which, as I say, is likely to be a lot lower and could impact on how much you're going to borrow. Now, if you're getting a holiday let that's a small 100, 150, 200,000 pound property, I wouldn't think that should be a problem. But if you're buying a holiday let that's, let's say, 300,000, 400,000 pounds, and you want to borrow 75% of that, then don't be surprised if the long-term rental figure that the lenders are using to work out borrowing means that you can't get the 75%. So there are lenders that will work on the holiday let figures, so that is the good news, but there's a big chunk of lenders that won't. So be very careful, make sure your broker's aware of that differentiation, and they may need to knock on certain lenders' doors that, as I say, use the holiday let projections. Maximum loan to value, yeah, really healthy. Most lenders will go certainly to 70%, lots will go to 75%, so no different to a normal buy-to-let mortgage. Interest only, just like buy-to-let, customer choice, so no issues there. The one area where lenders are lagging behind is if you want to buy your holiday let within a SPV, so a special purpose vehicle or a limited company in plain English, then the choice of lenders is quite minimal right now. If you're buying in personal name, that's where the bulk of the lenders and mortgage products are out there. So I would expect that to change, but right now you can probably count on one hand the number of lenders that are offering holiday let mortgages in limited companies. So just be a little wary of that. The final thing is on property types. So if you're getting a 2, 3, 4, 5, 6 bed holiday let, not an issue. The second you go to a 7-bed holiday let, we're in new territory, and there's knock-on effects and challenges, let's call it, with obtaining mortgages. Haven't time to go into that in any more detail. Just be aware, 7-bed holiday let can be an issue. Speak to your broker about that before you start putting offers in and getting too carried away, because it's quite challenging to get those larger holiday lets right now. Something that we get asked about quite regularly from landlords is the need for insurance and protect things like life insurance. You may think that because you have rental income, whether you're ill, even seriously ill, well, surely that rental income is going to come in irrespective. So why would you need to organise things like life insurance? Now, here's my challenge is that to you is, yeah, I get that if you've already built your property portfolio to where you want it to be. If you've already got that income stream at the level that you're aiming at to get that passive income in, then fine. But most of us are actually on that property journey where we haven't got there yet. And that's where, therefore, we're still vulnerable, where you haven't achieved your financial goal of achieving a certain level of income. So that's where your portfolio and yourselves are vulnerable. So I would suggest that you talk about your insurance advisor, that additional layer of protection whilst you're building your portfolio. Because if something goes wrong on that journey, then the insurance and protection hopefully then can pay off all the mortgages, and that clearly then boosts the income and allows you to achieve the goal, and illness or indeed something worse is not going to get in the way of that being achieved. Once you've achieved that goal, do you need life insurance at that point? Well, that's I think is a more open for debate. The other thing to talk about insurance, and this is a question I want to pose to anyone who already has life insurance. Do you know if your life insurance policy that you've currently got is in trust? Now, if you're looking blankly at the screen right now or going, I don't even know what a trust is, I suspect the answer is going to be no. But either way, here's a challenge. One, try and find your policy. Once you've found it, dust it off and have a look to see if it's been put in a trust. Why is this important? Well, two reasons. One, for payout purposes. If it's not in trust, then a life insurance payout forms part of your estate. And if you've ever been involved as an executor in dealing with probate, then probate can take months and occasionally, sadly, years for probate to be granted in more complicated cases. And therefore, any money, life insurance payouts being an example, will get caught up in that trap of being locked in probate. And so the people that really, really need it, those beneficiaries that you wanted to have that money, if something really horrible happened, you cannot access those funds until probate's granted. And if that's 6 to 12 months later, that's clearly not what the intention was. If it's in a trust, that money is outside of your estate completely. And therefore, the life insurance company can write a check. That's how old I am. I don't suppose they write checks anymore, but can issue that money within a week or two and get it to the people that need it, those beneficiaries that now may want that lump sum to either pay debts off or being able to just keep the bills being paid, etc. The other benefit of placing your life insurance in trust is that, as I've said, it takes that pot of money, that life insurance payout, outside of your estate. So it's not counted towards your estate for inheritance tax purposes. That's huge. If otherwise, let's say you've got I'm going to make up figures, £500,000 of life insurance payout that was not in trust, and that £500,000 was eligible for inheritance tax. Inheritance tax, I think, was 40%. So that's 200,000 of a 500,000 payout. You're going to wave by it and give to Her Majesty's Treasury. Thank you very much. If it's simply in a trust, then it's not deemed part of your estate, and therefore your beneficiaries will receive 100% of that £500,000. So potentially huge savings there simply by putting it in trust. If you want to know more about trusts, then clearly you can get in touch. Existing policies can be quite often put into trust, or it might be something that's done from scratch. Finally, just to wrap up, brief summary of the services that we provide. If anyone does want any additional advice or just a chat in these areas, all the different types of secured mortgage finance, from bridging to commercial as well. And if anyone wants to take a quick screenshot, various ways to get in touch. including if you want to book a free appointment, we'll give you 30 minutes, at least 30 minutes of an advisor's time to have a chat and try and help you answer all those questions that you've got. But there's also other ways of getting in touch. And that's our mortgage update for July. Thanks for listening.